Welcome to TSIB Talks, where we share information on construction insurance and its possible effect on your business. Enjoy our latest episode.
Hi everyone, we would like to welcome back Mike Dugan for another episode of TSIB Talks. Today he's going to be talking about the 2026 Surety and Construction Forecast. Mike, if you want to reintroduce yourself real quick, you can go ahead.
Yeah, thanks, Dom, for having me. Mike Dugan, I work with Turner Surety, an insurance brokerage, and work in the Surety department.
Thanks, Mike, and welcome back again. We're going to jump right into things here, starting with the big picture. When contractors and owners are looking at 2026, what should they be seeing?
Well, if you just look at the numbers, the construction market in 2026 looks pretty strong. Backlogs, I think, are healthy. Capital's flowing, infrastructure spending solid. But if you actually talk to people running work, actually the contractors, there's this weird disconnect. Contractors are busy, but they're not comfortable. Owners are funding projects, but they're asking harder questions than they used to. And on the surety side, we're still supporting growth, but underwriters are being more selective about the contractors they support.
Now, what's driving that shift? Why the change in mood?
It really goes back to the last few years. The industry went through supply chain chaos, labor issues, inflation hitting in ways nobody expected. I mean, you can see it in the surety loss ratios. For example, losses jumped to almost 25% in 2023, then pushed even higher in 2024. So in 2026, nobody's pulling back exactly, but everyone's definitely recalibrating.
So it's not like a hard market where capacity dries up, but it's more cautious?
Yes, exactly. Capacity's still there, competition's healthy, but what's changed is selectivity. Sureties aren't just looking at historical performance or growth projections anymore. They want to understand how you make decisions as a contractor, how risks get flagged internally, how you catch problems before they turn into claims, which is a totally different conversation than it was a few years ago.
Your forecast talks a lot about execution risk. What's going on there?
Labor is still the big headache, and it's not just about finding people. It's about keeping them and actually getting consistent output. High turnover, skill gaps, heavy reliance on subs who are already stretched thin. All that creates unpredictability in how projects actually perform. And what makes this really interesting right now is the economic disconnect we're seeing. Third quarter GDP came in at 4.3%. which is strong growth, but in November, total job creation was only 64,000 jobs, and construction added 28,000 of those jobs. So construction accounted for nearly half of all the job growth in the economy, while unemployment hit 4.6%, which is the highest since September 2021.
What does that mean for contractors?
It means construction staffed for continued strong activity while the broader economy is showing weakness. The rest of the economy is growing through productivity gains and capital investment, but construction is still fundamentally labor intensive. And when you layer on the fact that productivity improvements haven't kept up with wage growth, despite all the investment in technology and project controls, you've got margin pressure building.
And it's not just happening at the GC level, right?
No, and that's the thing. The stress is compounding down in the subcontractor tier. Specialty trades, electrical, mechanical, building envelope, they're stretched really thin. A lot of them are thinly capitalized, absorbing cost increases without much negotiating leverage, dealing with payment timing issues. Subclaims have gone up while loss severity has ticked higher. So you're seeing deterioration on both frequency and severity at the same time. A general contractor can look completely stable on paper while they're sitting on a backlog where maybe 20% of their critical subs are quietly struggling, and that risk doesn't show up in the GC's financials until projects start falling behind schedule.
So from a surety perspective, execution risk is the main thing you're worried about now?
Yes, absolutely. Projects fail today not necessarily because contractors ran out of money, but because schedules fell apart, crews couldn't keep pace, or coordination broke down across complex scopes. The 2024 loss experience proves this out. In 2026, the best positioned contractors aren't necessarily the ones with the lowest labor costs. They're the ones with the most realistic assumptions baked into their bids.
How's the surety market adjusting to all this?
Well, premium volume's grown more than 40% since 2021, which reflects both construction market strength and competitive appetite. But that growth came at a cost. A lot of it got underwritten with assumptions about labor availability, schedule predictability, margin durability, assumptions that turned out to be optimistic. So now the industry is recalibrating a bit, not by pulling back capacity, but by looking at assumptions that went unchallenged during the growth phase.
What does that actually look like day to day?
It actually shows up in pretty tangible ways. More focus on interim reporting and job level transparency, and not just year-end financials, but real scrutiny of aggressive growth strategies. Way less patience for repeated one-time explanations and whip schedules, and more dialogue around bid discipline and how a contractor is selecting projects. And here's another signal. Defense and cost containment expenses as a percentage of earned premium have gone from nearly 2% in 2022 to almost 3% in 2024. That's not just losses. That's increasing complexity and the cost of managing troubled projects. More jobs are requiring intervention, completion contractors, extended negotiations, and litigation before they even reach claim status.
So underwriters basically have longer memories now.
This isn't a hard market in the traditional sense. It's a market that's absorbed some painful lessons and adjusted its standards. For contractors, the message is pretty straightforward. Bonding capacity follows clarity, discipline, and trust, not projections, not optimism.
Does this play out differently depending on how big the contractor is?
Yes, absolutely. Small contractors still have access to bonding, especially in public work, specialty trades, and private development, but the margin for error has narrowed. Sureties are paying closer attention to cash flow, underbilling trends, reliance on key employees. Informal financial practices that might have been overlooked before are getting questioned now.
What about mid-market contractors?
That's where it gets most complex. These are firms that have outgrown small bonding programs, but haven't hit institutional scale yet. They're often chasing larger, more sophisticated projects, competing against national contractors, managing multiple work fronts at once. The opportunities are real, but so are the failure points. Firms that show disciplined bid review, realistic scheduling assumptions, willingness to walk away from marginal work, they're getting much better treatment from sureties than firms that just are chasing growth at any cost. So in 2026, mid-market success is less about expansion and more about control.
What about large contractors?
Well, capacity remains strong, but it's getting more sophisticated. Traditional full penal sum bonding still central, but on mega projects, it's often just one piece of a broader risk management framework at this point. We're seeing co-surety arrangements, parent company guarantees, partial bonding supplemented by letters of credit. For contractors, bonding strategy isn't just a compliance exercise anymore. It's part of a project planning and contract negotiation from the start. Scale matters, but discipline matters more.
Your forecast identifies some specific risks the market should be watching. What are the big ones?
Well, there are three that stand out as systemic risks, the kind that could shift things faster than people expect. First is data center backlog concentration. You've got maybe 5 to 7 hyperscalers, so Microsoft, Google, Amazon, Meta, Oracle, driving the vast majority of demand here. Projects are massive, timelines are compressed, and everyone's assuming AI compute demand just keeps accelerating forever. From a surety perspective, it looks safe on paper, but schedule compression's creating execution pressure, and power grid capacity limitations in key markets could limit how many projects can actually move forward. Because so much contractor backlog is concentrated with the same handful of owners, a sector pullback here creates exposure across multiple projects at once.
What's the second one?
Labor cost acceleration outpacing contract adjustment mechanisms, I would say. Most fixed price contracts have limited to no escalation protections for labor. So if wage pressure accelerates beyond what's currently baked into forward pricing, margins could compress very quickly across segments.
And the third?
I'm thinking that would be a mega project failure. The industry hasn't seen a truly catastrophic mega project collapse in this cycle, and one $2 billion project blowing up spectacularly, especially if it involves a well-regarded contractor, could reset risk appetite across the surety market. We saw this with Boston's Central Artery project years ago. It increased from $2.8 billion to well over $15 billion, and then culminated in a fatal tunnel ceiling collapse. The fallout from that changed how sureties and owners approached mega projects for years. One high-profile disaster can rewrite underwriting standards very quickly.
Are these things inevitable?
No, and most are manageable if they develop gradually. The concern is 2 or 3 of these hitting at the same time in the way that turns a healthy selective market into a defensive one.
So, Mike, if contractors were to take away one thing from this conversation, what should that be?
I would say transparency matters more than ever. Contractors that can explain not only what happened on a project, but why and what they learn, build trust that pays off when capacity matters most. The 2026 environment isn't constrained, but it is discerning. Activity's strong, capital's available, opportunity exists across all segments, but recent experience has reset expectation. Bonding capacity follows clarity, discipline, and trust.
Awesome. Well, that is all the time that we have today. Mike, I want to thank you again for coming on the podcast. It's always a pleasure to have you on, and I'm looking forward to the next one.
Thanks for having me, Dom. Looking forward to coming back.
Thanks for listening to this episode of TSIB Talks. If you like this content, be sure to follow for new episodes. Until next time.